The Fed set to announce a decision on interest rates this afternoon. Joining us now, Mark Cabana, head of U.S. rates strategy at Bank of America Securities. I'm getting ahead of myself because I've got all kinds of questions about the dual mandate. That I can look at it from both sides now, like Joni Mitchell. But what point were you making off camera about QT?
Yeah, well, look, the Fed's widely expected to cut 25 basis points today. That's fully in the price. The market will be looking for any guidance on December. We don't think Powell will be as forthcoming as what is priced. The market's expecting almost another full cut at the next meeting. But what we do think will be of a lot of relevance and more than usual is what the Fed's doing with its balance sheet. So as you probably know, the Fed, for the last almost 2.5 years now, has been shrinking its balance sheet. It's been reducing the amount of excess liquidity in the system. And money market rates have started to move in a way that we think will now prompt the Fed to stop that process. So they're seeing money market rates move higher somewhat quickly, I think a lot faster than they expected right now. And that's going to cause them to make some adjustments as far as what they're doing with their balance sheet, and then maybe even adding additional liquidity to offset some of those pressures.
So that's like, is that like a 50 basis point cut instead of a 25?
No. But the magnitudes that we're talking about in terms of the Fed's balance sheet do matter. They've shrunk their sheet by over $2 trillion since they started this process. They thought they'd be able to run it, at least according to some Fed officials, for another almost $300 billion. And they're finding that actually they can't. And the risk here is that if they don't stop QT and if they don't add liquidity into the system, then there's a risk that these movements will end up actually forcing several market participants to deleverage, because the cost to borrow will have risen so much and potentially unexpectedly.
But yesterday, Rick Santelli gave a D+ to the Treasuries auction that was out. So, and he based on not a whole lot of demand out there.
So we think that overall Treasury auctions have been going fine. But that is predicated on relatively stable sources of funding and availability of that funding. And the risk, as I noted, at least with the balance sheet, is if the Fed doesn't do anything, they could potentially see money market rates rise a lot faster than they were expecting. That could force the cost to borrow and cost of leverage to tighten more meaningfully, and that could be a headwind to broader financial conditions.
But there's only so much the Fed can do. Even if they cut rates, it doesn't mean that they can make buyers come in and buy Treasuries at the rates they're talking about.
Of course. But what the Fed can do is that they can manage overall money market rates, help manage the cost of leverage, so that it's not prohibitively expensive for market participants to do that. And that's what we think that they will do. Yes, that's right. And that's why some of these plumbing issues do matter at moments like this.
That is a plumbing issue. But let me talk overall. So we've talked about 3% inflation and maybe a weakening, or maybe the labor market is not weakening. Why would you? That gives us no reason to cut. But then I can see a reason to cut, because I think the 3% is illusory. I think inflation is anchored and maybe on its way down. I don't know if it gets to 2, but I don't think it's the worst case scenario comes to pass. And I think the labor market is actually reflecting a lot of things other than demand in the economy right now, isn't it? With the workforce, the participation rate, AI, all these things are playing into that number that we see.
So it's a naturally tricky time for the Fed, especially without government data. Normally they go in with a full set of official sector data.
When they have data, it's
they
shitty.
Don't have that.
It's not great data. Sorry.
Yeah.
But when they have data, it's been, they've been off by 50% on the jobs. So, and a lot of times, even with the data, their visibility is not that great.
Okay, so the Fed doesn't have the data that they normally see. We can debate the quality of that. But what we can see at Bank of America is through our Bank of America Institute, which is part of our research world that actually looks at Bank of America proprietary data, we can get a glimpse into some of what is happening. And our colleagues, Liz Everett and team, do a great job of slicing this. And here's what we see right now. We still see a relatively resilient consumer. Now, especially around Washington, D.C., with the shutdown, you've seen spending slow a little bit. But we also see that hiring is slowing. So it's a bit of a conundrum because you have a resilient consumer, slower hiring. And the thing that's most notable to me in the data that we have is that wage growth is actually rising. So it's a bit of a funny setup right now because it does appear that growth and the consumer are strong. Corporate profitability, as you know, is quite high.
Right.
And equities are near all-time or at all-time highs. Yet we're seeing a slowdown in labor, which may be influenced by changes in population. Obviously, immigration has impacted, or AI, stuff. That's right. But for the folks who do have a job, we are seeing at least that wages are rising.
That does make
so
no
it's
sense.
a bit of a mixed
like
picture.
Specialized people that can ask for wages?
Hold on to the people that you're there. You don't
well, we do think,
on.
and you'll probably hear Powell characterize the labor market today as low, higher, low.
Amazon
fire.
doesn't want to hold on to the people that are already there.
Sure.
That's the lead story in the journal.
Sure.
White collars now being
impacted by AI. But again, we think that the labor market broadly can be characterized as low, hire, low, fire. If you have a job, if you're adding value, if you're a designer, let's say, of a system, then you probably do need to be retained because you are able to expand productivity and maybe profitability as a result of that.
But what happens if you're a designer?
What are we?
Then it can be more challenging.
Right.
And I do think that that is a bit of the conundrum.
But aren't there a lot more designers than designers of systems?
That is probably true. And in that environment, the Fed's going to have to look and say, well, how do we assess this labor market? Now, they've clearly shifted to be more concerned about the labor market versus inflation. But within the labor market, they're probably seeing some mixed signals. So they cut once in September. They're going to cut again. The market widely expects that they will cut again in December. We think that's much less of a sure thing.
And that is a blunt tool to try and fix the labor market.
That's
but
right.
it's also crazy because they're 50% above their target on inflation, and we're really not convinced the economy is necessarily slowing.
Correct.
This is not a time when you would normally be cutting rates unless you're able to do it because of productivity gains and, some of the things you're saying are illusory. That's
Correct.
the word I use.
And look, that's why we think in the rates market will hear a Fed that is not as dovish as currently priced. That will likely mean that front-end rates rise a bit after the decision today.
Right.
That may be a headwind for equities and other risk assets because the market's going to likely hear a more cautious cutting Fed, especially given that the Fed doesn't have data that would normally inform its decision.